After studying this module, we shall be able to learn and understand the concept of financial system, B. Identify the nature and various components of financial system, C. Examine the various aspects, types and functioning of different parts of various financial system, D. Analyze the linkages of the different classifications of financial market and their effect on financial system, E. And lastly, evaluate the interrelationship of financial system and economic development. The financial system in any economy is the most important component of growth, as this facilitates mobilization of savings and its efficient allocation. This judicious allocation leads to proper utilization of scarce resources, which result into the most profitable investment. Therefore, the primary function of the system is to provide a link between savings and investment, which leads to generation of more and more wealth. We shall now discuss the meaning of the term financial system. The term financial system refers to a group of financial activities which are interlinked with each other and in totality. These make a complete process with a specified purpose. The system has financial markets, financial institutions, financial services and financial instruments as its parts, which make it a complete whole. Van Horn defined financial system as the purpose of financial markets to allocate savings efficiently in an economy to ultimate users, either for investment in real assets or for consumption. Christie has said that the objective of financial system is to supply funds to various sectors and activities of the economy in ways that promote the fullest possible utilization of resources without destabilizing consequences of price level changes or unnecessary interference with individual desires. Let us understand the structure of financial system. The financial system of any country consists of financial institutions, financial markets, and financial instruments and services which facilitate transfer of funds. Financial institutions are further subdivided into two types. Number one, banking and non-banking classification, and number two, intermediaries and non-intermediaries. Financial markets are divided further into organized and unorganized markets. Financial instruments are either short-term or long-term or medium-term claims, assets and securities. The diagram given below explains the various components of a financial system. We will now throw some light in the various functions of a financial system. Financial system performs various functions, some of which are mobilization of resources. 2. Allocation of resources. Number 3. Facilitating pooling of risk. Number 4. Facilitating distribution, diversification and hedging of risk. 6. Facilitating exchange of goods and services. 7. Offering various financial instruments to suit the preference of savers and investors. 8. Increasing the liquidity of financial claims. And 9. And lastly, facilitating better portfolio management. How efficient and effective is the transfer of funds depends upon the efficiency and soundness of the financial system of any economy. Therefore, a strong and vibrant financial system contributes towards the most effective and efficient allocation of resources from surplus spending economic units to deficit spending economic units. This optimal use of resources leads to economic development of the country. However, there are conflicting opinions about the role of financial system in economic development of a country. According to Solow, model of economic growth, growth results predominantly not from the increase in labor and capital, but from the technological progress. Therefore, money and finance and the policies about them cannot contribute to growth process. The other view regarding money as the most important tool for the economic development. We shall now study the various theories explaining the interrelationships of financial system and economic development. The interrelationship of finance, financial system and economic development can be better understood from some of the given theories. The classical prior saving theory, the credit creation theory, the forced saving theory, inflationary financing theory, financial repression or financial regulation theory, and financial liberalization theory. We will discuss these theories one by one. Let us now consider the classical prior saving theory. This theory is of the view that savings are a must for investment in any economy and all savings find some investment outlets. The theory stressed the need for mobilizing savings, which is possible if monetary policies support high and real interest rates to be offered to public for saving, which, if invested, will lead to economic growth. A well-developed financial system helps in mobilizing money from surplus spending units to deficit spending units and helps in increasing the volume of investments and output, thereby transforming a given amount of investment into more productive forms. Thus, an efficient financial system increases resource allocational efficiency among different investment avenues and reduces the cost of finance and risk by providing various insurance and hedging opportunities. Let us now discuss the credit creation theory. This theory is of the view that credit is created in expectation of savings, and this ensures some level of independent investment which generates the appropriate level of income, which in turn leads to an amount of savings which is equal to investment already done. Therefore, investment generates income, and this is facilitated by credit creation, which takes place in an efficient and sound financial system. In a nutshell, the financial system facilitates generation of credit and its appropriate investment, which leads to economic development. Let us now throw some light on forced savings theory or inflationary financing theory. The theory's main focus is on monetary expansion, that is, increase in money supply, which is the catalyst of growth in any economy. As per this theory, monetary expansion leads to increase in aggregate demand, output, and will induce savings. If the resources are fully employed, this monetary expansion will increase inflation, which in turn will shift investment into physical assets rather than financial assets due to low return. This shift of portfolio will increase output and therefore savings. This is known as Tobin or portfolio shift effect of monetary expansion. The theory also holds that inflation reduces the purchasing power of money, which is a kind of tax on the money which redistributes money in favor of the government. Therefore, this theory is of the view that low rate of interest is the key to economic growth, as it increases investment in physical assets and thus force savings via increase in output. We will now discuss the financial repression or regulation theory. The proponents of this theory are of the view that allocative efficiency of the capital is improved only when interest rates are kept low by the government. Competition does not ensure efficient resource allocation, especially in the underdeveloped and imperfect markets. Financial regulation protects the less developed financial market from market failures. Competition does not ensure protection of stable payment system, and it increases the possibility of bank failures and loss of public confidence. Therefore, administered interest rates and finance through government intervention supports financial market. We will now understand the financial liberalization theory. The proponents of financial liberalization theory are of the view that financial repression leads to fixation of low interest rates, which does not ensure allocative efficiency of capital, and generally investment takes place in low productive areas with no compensating returns, leading to fragile financial system. Directed credit programs by the financial institutions do not ensure optimal utilization of scarce finance, thus adds to a burden on society with no proportionate output. Financial liberalization helps the financial system of an economy to strengthen. It also puts the system and the economy on the growth path. Economy starts growing at a much faster pace than ever before in terms of GDP. It increases the foreign exchange reserves. It increases in the standard of living of people, and so on. Financial liberalization offers the following advantages. Number one, it allows the market forces to operate freely and let the equilibrium level of interest rates to be determined through it. 2. It increases the allocative efficiency of capital into the investment projects, yielding high returns. 3. It increases the average productivity of capital and results in increased output. 4. It increases savings and reduces the holding of real assets. 5. It helps in expansion of real credit supply. And 6, and lastly, it leads to a sound and effective financial system, thereby increasing the level of economic growth and development. We shall now study about financial development. Financial development of any economy depends upon its financial structure. Financial structure of any economy in turns depends upon the economic progress of the country. If the economy has a strong and sound stock market, debt market, insurance companies, pension funds, mutual funds, etc., an effective non-banking financial sector, this shows a high level of financial development. Financial development of any economy can be judged by the presence or absence of the indicators such as: number 1, finance ratio, that is the ratio of total issue of primary and secondary claims to national income. 2, financial interrelation ratio, that is the ratio of financial assets to physical assets in the economy. 3, new issue ratio, that is the issue of primary issues to the physical capital formation. 4, intermediation ratio, that is the ratio of secondary issues to primary issues. 5, the ratio of money to national income. 6, the promotion of current account deficit financed by market flows. 7, the level of integration of domestic and international financial system. 8, and lastly, the level of government intervention in credit allocation. Therefore, the indicators given above can be analyzed to judge the extent of financial development of any economy. The greater the level of financial development, the higher would be the level of economic development. We will now understand the role of financial system in increasing long-term prosperity, that is a point of debate. It has been said that there has been a direct link of prosperity and long-term growth with the effective and efficient financial system. A strong financial system results in good economic progress, reduction in poverty, it increases the standard of living of people. But there are many questions to this link. The role of financial system in the economic development depends upon happenings of many factors which, if do not happen, will not result in any economic growth of the country. Some of these factors can be summarized as: A, the financial system will help in the financial development if the financial system itself is efficient, otherwise it will not help. Thus, the development of economy based on financial system is possible only when system works efficiently, which in reality may not happen. B, there has been asymmetric dissemination of information which does not lead to equitable gains for all. C, stock markets rarely depict fundamental valuation efficiency. D, good volumes at stock market have no necessary relation with real investment. E, risk reduction and better risk management is also not assured even with multiple financial instruments. F. Raising of funds from debt or new issue is also less, and therefore there are less funds for real new investments. G. Market speculation leads to high volatility in share prices. 8. Fluctuations in trade balances also result in high volatility in foreign exchange rates. I. Utilization of society's resources into more productive channels is less facilitated by financial markets. It has been seen that private benefits are more than public benefits. Therefore, it may be concluded that if financial system works efficiently, only then it will result into long-term prosperity and growth of any economy of the country. We will now recapitulate what we have learned so far in this module. Let us summarize all the points one by one. Number 1. The financial system represents a set of interrelated financial activities in different parts of the financial system. 2. A sound and efficient financial system facilitates trade and therefore specialization in mobilization of savings. Its effective distribution is assured. It facilitates pooling of risk. It facilitates distribution, diversification and hedging of risk. It facilitates exchange of goods and services. It offers various financial instruments to suit the preference of savers and investors. It increases the liquidity of financial claims and facilitates better portfolio management. 3. It has financial institutions, financial markets, financial services and financial instruments as a part of financial structure. 4. Financial institutions reduce the cost of transferring savings to investors through risk pooling. 5. Financial markets are the centers that provide facilities for buying and selling of financial instruments. 6. Various theories have been propounded by various researchers. Those theories have been summarized and discussed in the module are the classical prior saving theory, the credit creation theory, the forced saving theory or the inflationary financing theory, the financial repression or financial regulation theory, and the financial liberalization theory. All these have been developed to understand the impact of financial development on economic development and role of financial system in economic development. 7. To understand the level or extent of financial development, various factors indicating it are discussed. 8. Finally, whether there is a direct link between financial sector and financial development has been explored and different criterion have been used to see link between the two.